The jobs report for September will be out on Friday. For now, the ADP report shows 89,000 people were added to private payrolls last month. That number was below expectations of 150,000. Let's bring in Joe Tigay. Joe, what's the market reaction?
Yeah, the market's setting up for the jobs report on Friday. After that, we're going to have the CPI report next week. Those are two critical events that are going to move interest rates, and interest rates are moving the market. That has been the story lately. We're seeing a very sharp rise in the back end of the curve. Looking at the 10-year, that's gone from 430 up to 470 really fast. And this has really driven the yield curve to close to it was inverted. Now it's getting closer to its normal reverted shape, which it historically has been. Now, if you go back to the start of the year, I would have been, Angie, in the camp that this inverted yield curve is going to lead to a recession. If you go back historically, it's a fantastic predictor of a recession, and the recession will happen when that yield curve reverts to its normal shape. The problem is right now is it's not going the way that it historically does. Usually when that inversion reverts to its normal shape, the 2-year, the front end of the curve drops down. That's a sign the economy is slowing. That's a sign the Fed needs to lower interest rates quickly. The reverse is happening right now. The back end is going higher. That's a sign of a strong economy. That's a sign that the Fed needs to keep rates higher for longer. So it still remains to be seen. Maybe the rest of the reversion will happen with the 2-year falling. But for right now, it seems like the economy is strong enough to justify these higher rates.
I love that you're talking this way because so many people are calling for doom and gloom, recession. We try to give all views of what the market is signaling. What else are you seeing?
We'll get a good look on that on Friday in the jobs number, how weak the economy is. But it's been stronger than people have expected all year long. It's defied those expectations, and there's reason to believe it still will. In this jobs number, again, anything is possible. That said, if you look at these interest rates, also, you back to 2022, the 10-year was about at the same spot at this point in October of 2022. People calling for the end of the world, saying that growth is going to fall off a cliff. That hasn't happened in 2023. In fact, we've seen a 40% rise in the NASDAQ since where we were a year ago. So it's really amazing how resilient these equities have been, especially the mega cap tech stocks, the top 7 stocks that are leading this economy. They're not very sensitive to interest rates. They have a ton of cash. And as long as the economy remains healthy, they're going to do just fine.
Very fascinating. Thank you, Joe.
Thanks for having me.
Go to businessfirstam.com for where to see our show on TV.